Hi students, how are you? So in today's session, we are going to do the foreign currency IAS 21 LKAS 21. Okay, foreign currency transaction, right? Foreign currency. That means we have to do our accounts in our own currency or the functional currency, right? We used to do our accounts in functional currency. Foreign functional currency, the currency that denominates sales price, right? Functional currency, we can say the sales invoices, what the currency is borne by the sales invoices. In what currency we raise the sales invoices, right? Through that we can identify which is the functional currency and operational cost, right? And currency influences the operating cost, right? The currency, our operational cost is the what the currency we uses to cover our operational cost, right? And entities finance are determined in which currency we finance our businesses, right? Through that we can identify what is our operational currency. In India it's Indian rupees, in Sri Lanka it is Sri Lankan rupees, in UK it is pound, and in Switzerland it is franc, right? Even though it is in the European Union, it doesn't use euros, it uses franc, right? That's what I Swiss franc, right? So that is the difference. First of all, you have to identify your functional currency by observing whether the currency that denominates the sales price. Sales price, how we denominate, in which currency we denominate the selling price. And currency influences operational cost. The currency in which, what is the currency we uses to cover our operating cost, entities finance or determined by, right? And second one is recognition and measurement. Recognizing the functional cost, recognizing the rates, right? The recognizing the functional cost we have seen earlier. This is recognizing the recording of measurement, right? Record the transaction at historical rate. At the beginning of the transaction, you record the transaction at the historical rate. Means historical rate means at which, when you are purchasing that particular, if you are doing, if you do businesses with different currencies, right, different countries, so you may have to use the different currencies. That means you if you are dealing with the other countries other than the European Union, you have to use the dollars, American dollars. If it is for the European Union countries, you have to use the, what do you call, I have forgotten, European Union, I have forgotten. But if you are using the, if you are dealing with the UK, you have to use the franc, right? But other countries you can use the dollars, right? Euros. For the European Unions countries, coming under the European Unions, you have to deal with the euros, right? Not in the dollars. So that is what we are mentioning. That is what they say, record the transaction at historical rate, right? The rate which prevails when the transaction taking place, when the transaction taking place on the date of the transaction, what is the exchange rate prevails, that is called historical rate. Once you have dispatching, you are sending your documents, that is the date, right? Record the historical rate. Monetary assets, liabilities translated using the closing rate, right? Monetary assets and liabilities are translated at the closing rates in the sense the reporting date, the rate available, the rate prevails at the reporting rate, that is called reporting rate, closing rate, right? With the with any gain or loss, with any, okay, with any gain or loss. Non-monetary assets and liabilities are not translated, state in the fair value. Non-monetary items on the fair value, not translated, right? Not retranslated, right? Recording the gain, trading transactions, operation cost. Recording the gain, trading transactions in the operating cost, finance transaction in the financial cost, right? That is what the normal summary of the foreign currency. So we will do the questions, then only you can understand, okay, what is the foreign currency. So question number 1, functional currency 1, Joe's Insurance Company Limited, right? X company, first question number 1, right, says it trades with the several supplies overseas and bought goods costing 400,000 dinar on 1st December 2007, right? 1st December 1st December 2017, right? 1st December 2017, right? They bought goods on dinar, goods goods purchased for 400,000 dinar, right? Dinar, okay, 400,000, okay. Then Jones paid the goods for on 10th January. 10th January only he is paying, right? We will keep it as it is. 10th January, 10th January 2018 he is paying payment. Wait, right? Payment date. Okay, we will keep this one. 10th January 2018 he is paying the amount. First year in the 31st December 21, the exchange rates are as follows. 1st December 2017, second 31st December 2017. Then show the transaction that would be recorded in the financial statements, right? That would be recorded in the financial statements. First of all, goods purchased should be in historical rate, right? So 400,000 into how much historical rate? That is on 1st of December 2017, 4.1 dollar. Dollar is 4.1 divided by 4.1. That is equal to 97,561. 97,561. 97,000. For this, you will do the pay. You didn't make the payment, no? Purchases account debit, right? Debit the purchase account 97,561, right? Debit purchase account debit 97,561, right? And payables to payables credit 97,561. This was the initial recording. Once the sales is made, this is the recording made. This is a one, number one, right? Question number one, right? This is a one. And third year end 31st December 2017, right? The inventories is there. Inventories purchases year end, we will have the inventory. Inventory and payables, right? Inventory and payables. Inventory of 97,561 and payables 97,561. Okay. On this date, we will have inventory and payables. 97 dollars, right? This is on dollars. This is in dollars. This is in dollars. That is, this is in dollars, right? So inventories are non-monetary item. It is not a monetary asset. Is it inventory is the monetary item? No. Inventory is a non-monetary item. Then non-monetary assets and liabilities are not retranslated. Non-monetary items are not retranslated. So this is not going to convert. We are not going to convert it to the closing date. This is the fair value. Then we will keep it as a fair value and historical rate, right? Monetary assets and liabilities retranslated using the closing date. This is the monetary. Payables are monetary item. Payables and receivables are monetary item. So it need to be converted using the closing rate, right? Closing rate. Okay. This is non-monetary item. Item. This is therefore it is fair value or historical. Fair value or historical. This is the monetary item. Therefore, closing rate is applicable. Closing date is applicable. So, in the question, they give 31st December 2017 is the closing date. That is 4.3. 4.3. Right? 4.3. Right? $4.3. Then, we'll convert it. 97,561 divided by 4.3, right? It is equal to t is equal to t is equal to 93,023, 93,023 dollars. So what is the difference? The difference will be payable higher amount. Now paid is the lower amount, right? Payable is the lower amount, so difference will be the gain will be 97,561 minus 93,023, that is equal to how much? 4,538, 4,538. This is the difference you will get. Okay, so double entry, what is the double entry you had to pass? Here we have to pass the double entry, right? Payables debit, debit 9 sorry debit 4,538, gain on retranslation right, is credited to 4,538, right? This is the accounting treatment. End of the year, right? This is the end of the right. Right, this is right. This is all. Journal. This is a journal entry for the when the transaction taking place. This is the end of the financial year, the journal entry, right? Next one is we have to see on the 1st of January, no? 1st of January. I will see whether you can see the blackboard. Yes, of course you can see. 1st of January, okay? 1st of January, sorry, 10th of January 2028, his settlement. So this before going to the settlement, we have to see how we can show in a financial statement, right? Statement of financial position, right? And statement of profit and loss. In the statement of financial position, you will show payables as 93,023, right? And gain on in the other income, no? Right. No, no, no. Payables gain on retranslation. Gain on retranslation. That is 4,538. 4,538. Inventories will show 97,560. 97,560. This is what we will show. This will come under the current liability. This is come under the current assets, right? Current assets, current liabilities. Okay. So final one is I will raise this one. Okay. Have it taken out? Otherwise I can use here. This I am raising, right? You would have taken out. So I am raising this one. Other one is we are on 10th of January. 10th of January 2018, right? 2018 settlement. Settlement take place, right? Settlement, that is they have, what is the 400 settlement, that is 400,000 divided by what is the dinner, 4.4, I mean 4.4 payable paid, that is equal to how much, 9909, 90 909 dollars, right? These all are in dollars. Okay, dollars. Okay, right? 909. So in the financial statement payable we have mentioned 93,029, no? So cash of bank, right? First of all we will say cash of bank credit. Okay, bank account credited, right? 90,000 909 bank account, and the difference between the payable 93,023 is the payable. So whereas we have paid 90,901, so difference would be 2,140, 2,140, right? 2,114 is credited to profit and loss. Profit and loss, saying loss, gain, right? Gain on retranslation, right? Gain, PNL, right? Cost. And payable debitor. Payable will be debited 93 93,023. This is the journal entry. This is the journal entry gain, right? This is A, this is B, this is C. Okay. This is the 1st of December when we are purchasing. This is the closing time of the books. This is the payment time when we are settling. When we are purchasing, when we are closing the books, when we are settling the dues, right? These are the double entries I will. Okay. P&L gain, right? P&L gain. First P. Okay. So have you understood? This is derived the difference between these two. Okay. This is the closing the rate prevailing historical rate, right? Historical rate 4.4 of the payment time. Okay. So we will move it to the second question. Question number 2. This is Mr. Hall sold goods to overseas customer on 1st November 2018, right? 1st November 2018 he sold 1st November, sorry, 1st November 2018 he sold item for sold goods to overseas customers on 1st November, that is for 10 million. 10 million, right? 10 million. They agreed up 90 days pay term. No entries have yet been made to record this sale. To raise, although the goods were correctly removed from the inventory and expensed in the cost of sales, the amount remains unpaid at 31st December 2018. 31st December 2018 is unpaid. Relevant exchange rates are 1st December 2018 is $2.5 and prepare the schedule of adjustment that must be made to adjust draft retained earnings 3.5 million as a result of any adjustment related to the foreign currency, right? Retained earnings, right? On draft retained earnings, that is 3,500,000. 3,500,000. 3,500,000. Right? The exchange rate prevails at the rate of date of transaction is, right? That is 2.5. 2.5. Right? Revenue, that is 10 million into 2.5, that is 4 million. That is 4 million, right? 4 million, right? Other one is You have to see the closing rate is December 2.4 closing rate, that is closing rate is 2.4 2.4 no 2.4. So uh, closing rate, that is gain or loss, that is closing rate 10 million divided by 2.4, right? 2.4 minus 4 million, right? 4 million, that is divided by 2.4 million, in the sense 4 million 166, 4,166 and 667 minus 4, right? So that is 1 4 million, sorry, 1 100 and 166,660. So 7,666, 667. This is the amount that will appear in the retained closing. Exact retained earning will appear like this, right? Retained earning is applied. Drafted retained earnings does not contain the sales proceed because they didn't pass the entry for the sales, right? So we pass the entry on the spot rate, historical rate, in the sense the sales, the on the date the sales take place is 2.5 into 10 million, then 4 million is the there, right? 4 million dollars, right? Dollars, this is dollars, this is dollars, okay, this is dollars, okay, this is dollars, this is dollars, okay. 4,000 is there revenue, and we are adding the end of the date, closing date, we are applying the closing rate. Closing rate is 2.4, closing rate is 2.4, 2.4, this is 2.5, right? Closing rate, this is called as closing rate. Closing rate, this is called as historical rate, historical rate, right? Closing rate, we are applying the closing date. If we 10 million divided by closing rate, in the sense divided by divided sorry divided by 2.5, right? This is the amount that is called HR, right? Historical rate, right? Historical rate 4 million. When if we want to find the gain, 10 million divided by 2.5 into 2.5 minus 4 million, that is 4,166,667 minus 4 million, then it is a gain 166,667 and gain, right? Okay, this is the way you had to prepare the accounts. Okay, I hope you would have understood. So the foreign currency is not an difficult task, very easy, and you can score marks in this area. Okay, okay, thank you. I'm going to wind up this session. Thank you.